So I guess I can skip the first question now, right? Everybody's in a group? Or maybe I should ask the question anyway, because I had at least a couple of people who got shed by their groups. Don't ask me how this happens. I didn't ask any questions. So anybody not in a group yet? Okay. Who's not picked a company yet? Really? I don't believe you, but I'll let that go, So, but if you haven't picked a company, pick it. If you picked a company, time to start moving. So I'm going to start with a question I left with on Wednesday. I don't know whether you remember, but I said I'm going to show you a graph of risk-free rates. And we went through the process of estimating risk-free rates. Easy in some currencies, more difficult in others. And essentially, this is a page that lists out risk-free rates. So the way to read it is the blue part of the column, the blue component, is your risk-free rate. So let me start with an obvious statement. Risk-free rates vary across currencies. There are high risk-free rate currencies, low risk-free rate currencies, and even negative risk-free rate currencies. And the question I ask is, why do risk-free rates vary across currencies? What's the answer? Inflation. That's it. Okay. The reason risk-free rates vary is because of differences in inflation. So let's go through it. If you have a high inflation currency, you're going to have a high risk-free rate. If you have a low inflation currency, you're going to have a low risk-free rate. If you have a deflationary currency, you could have a negative risk-free rate. So already we have an answer question. Can risk-free rates turn negative? The answer is yes. It's uncommon but not unnatural. The usual pushback you get is, if risk-free rates are negative, why would people even invest at a negative risk-free rate? Right? That's a standard reason why in Econ 101 risk-free rates were bounded at zero, because risk-free rates drop below zero. What are we supposed to be all doing? Taking our money out of the bank and putting it under our mattresses. Which if you have only $20 is not a big deal. You probably weren't in a bank. But what if you have $20 million? You put it under a mattress, what's the next thing you got to do? Hire 2 security guards to stand in front of your house to make sure it doesn't get stolen. I don't know how much it's going to cost you, but it might cost you well over 0.5%. We are also paying the price of becoming a cashless society, which is, there are parts of the world now where if you have cash, you have a tough time actually getting people to accept the cash because they want to be paid with Apple Pay or credit cards. I think what we're seeing are the consequences, and increasingly as we move away from cash, those natural constraints which kept risk-free rates from dropping below zero are kind of dissipating. It is mind-blowing when you think about it, negative risk-free rates. Right? It's not just the government bonds that have negative risk-free rates. There are parts of Northern Europe where you buy a house. Normally when you buy a house, you borrow money, you've got to send a check to the bank. You actually get a check from the bank. So don't try to move to Northern Europe just to take advantage of it, because those low risk-free rates carry other consequences. What I'm trying to say in a long-winded way is, when you're analyzing a company, don't make the currency choice the central part of your analysis. Because if you pick a currency and you stay consistent, it's all going to work out. So you pick a high inflation currency, that's okay. Your cost of capital, your hurdle rates are going to be much higher. But when you do growth rates for your project, when you compute returns, they're all going to be in the same currency. The same high inflation that pushes up your cost of capital is going to help you when you compute your returns and your cash flows. If you pick a low inflation currency, again, don't worry. If you have a negative inflation currency and you have a negative risk-free rate, again, work with the risk-free rate. Don't mess with risk-free rates. You know what I mean by mess? A lot of people right now are messing with risk-free rate. They take the risk-free rate today and replace it with what they call a normal risk-free rate. Don't do that. Just take the risk-free rate, move on. Any questions about currencies and risk-free rates? So currencies are measurement mechanisms. They're not going to make your company riskier or safer. So that's why I want to separate country risk and currency risk, because you're dealing with two separate kinds of risk. So now let's talk about the equity risk premium. So we talked about risk-free rates. Let's talk about the equity risk premium. I mean, there are lots of, when you use the word equity risk premium, it sounds like a buzzword. So let me give you a sense of what the equity risk premium is trying to measure. It's trying to measure the price of risk in the equity market. the price of risk in the equity market. Who sets it? Investors. What drives it? Demand and supply. But demand and supply is such a lazy answer. You can give that for any price. So let's dig a little deeper to see what drives the equity risk premium. You'd expect it to be greater than zero. Why? Because if you can make something risk-free, investing in equities is risky, you'd expect it to be greater than zero. That's not saying much. It should be a function of how risk-averse investors are. You think, what drives that? Let's take a few dividing variables. Let's take age. Right? Younger people versus older people. Who's more risk-averse? Older people. Why? Well, lots of different reasons. But there's a consequence, right? If you have an investor population that's aging, what should start to happen to equity risk premiums? They're going to increase. So as you look at Japan and Europe, this is a concern. As you get aging populations, you're going to get higher risk premiums. What do higher risk premiums do? They push down stock prices, because to get that higher premium, you pay less. Here's a second divide, and this is a sensitive one. Men versus women. Who's more risk averse? That's a tough one, right? You think, should I even say something? It could be held against me. I mean, so I'm going to cover myself. This is from studies looking at men versus women. Young men are less risk averse than young women. And I can attest to that even with a sample size of 4. I have 3 boys and a girl, and the only person whose car I would get into when they were learning how to drive was my daughter. My sons, no way. They have no sense. There's something that happens to your brain between the ages of 18 and 25, I think, which makes you a terrible risk taker if you're a male. Actually, this actually has consequences, because you walk into any trading room and you look around, you're surrounded by young men. And then we wonder why we have so many trading fiascos that happen. In fact, only half jokingly a few years ago, after one of these big multi-billion-dollar, scandals, some trader wiped it out, I made a suggestion that if banks had taken, I think they could have saved a lot of money. What's the only factor that slows down a 19, 20, 23, 24-year-old male from taking risks? His mother. So I said, here's what banks should do. You hire a trader who's 26, 27, hire his mother as well to sit behind him saying, what are you doing now? Hey, don't do that now. You might have to pay, $75,000, but think of how many billions you might save in a trader going off the tracks. So young men are less risk averse than young women, but as you age, it turns out that risk aversion tends to converge. But a lot of risk aversion you're born with. Nothing you can do about it. And with my 4 kids, for instance, I can tell you which ones are never going to be invested in stocks. My oldest still comes out on the stairs holding on to the banister. Fixed income guy if you ever saw one. I might fall now. No? How about right now? My youngest, when he was 2, took off from the top stair expecting to be caught before he hit the bottom. There's an option trader. Something good will happen. Who cares? Just jump, right? So some of this you can't help. So in a few minutes, I'm going to put you to the test to see how risk averse you are with a specific example. But the reality is, even though this is a fairly homogeneous group in terms of age and in terms of where you are in your careers, you're going to see big differences in risk aversion kick in. So risk aversion reflects the investor population. And finally, it is also going to change depending on what you think of as the average risk investment. You're saying, what are you talking about? 30 years ago, if I asked you what the average risk stock was, you might have said GE or some big manufacturing company. Today, if I asked you what the average risk stock is, it might be a tech company, because the center of gravity in the market has changed. You're saying, so what? The way we assess risk now might be changed by what that median company looks like. The bottom line is, if you look at those factors, could they change over time? We're going to see in a minute why they might change over time, but let me put you to the test. As I said, let's talk about how risk averse we are in this room before we talk about the rest of the world. So I'm going to pose a question for you, and there's no right answer, so pick the one that best fits. So let's assume first that you have some savings. We have to start with that assumption, which might not be true because right now your balance sheet might be all tilted on the wrong side. No. But let's say you have savings. And you have all your savings invested in something riskless making 3% guaranteed. I've quit my job. I've become a salesperson for the Vanguard 500 index fund. So I want to be very explicit about what the choice is because if I just say equities, you might have a very different setting. And I call you and say, look, would you be interested in taking your money out of where it is today and investing in the Vanguard 500 fund? And if you're sensible, you say yes, as long as I get a higher return. So you ready? Here's the question I have for you. You're making 3% guaranteed. How much more than 3% would I need to offer you for you to switch from where you are right now, making that 3% guaranteed return, into an index fund of the 500 largest market cap stocks? I said, there is no right answer, but there is one very wrong answer. So let's make sure nobody picks it. Which is the one very wrong answer? Less than 3%. My suggestion is you drop the class right now. You're beyond redemption at this stage. Nothing we talk about is ever going to make sense. So clearly you can see why less than 3% doesn't make sense. In hindsight, could you make less than 3%? Absolutely. That's the nature of risk. But going into a risky investment saying, I'll settle for less than what I can make risk-free suggests that your head's not screwed on right. Right? So let's take the rest of the choices because they're all viable. Between 3 and 5%. How many people in this class would accept? So that's like, yeah. So is he the most risk-averse or the least risk-averse person in the room? He's the least risk-averse person in the room because when you're less risk-averse, you accept a lower return for taking risks. And if you're telling the truth about this, because the reason I say that is not because you're a liar, but unless you actually put money into something, it's abstract. Here's what I'd expect to see. You'll be into stocks sooner than most other people. More of your wealth is going to be tied up in stocks. My only suggestion is that you don't marry somebody who's the other end of the spectrum. Right? Because in a sense, then you're going to be wrestling with where do we put our money. So that's a risk premium between 0 and 2%. 5 to 7. Okay. 7 to 9. Looks like the middle of the distribution there. 9 to 11. And more than 11. Don't walk behind them on the stairs. Right? Most risk-averse person in the room. Again, it's not good or bad. It's what you're born with. Right? And if this were the entire market, you know what I'd do? Because each of you has now given me an equity risk premium, right? 0 to 2, 2 to 4. I would take a weighted average of the numbers you came up with. You're saying weighted by what? Not by how much enthusiasm you showed when you put up your hand, but by how much money you have. Let me be brutally honest with you. If you have no money, I don't care what your equity risk premium is. You can scream it, you can get on roofs and yell it. I don't care. If you have $10 million, I'm listening, and if you have $40 billion, I'm listening really carefully. This is not a democracy. It's a dollar-weighted democracy. This is why people care so much. What does Warren Buffett think about the market? Because when you have tens of billions of dollars behind you, what you think about the market matters more. But if this were the entire market, that would be the equity risk premium. And as you become more risk averse, that number is going to rise. Have any of you checked the market today? Don't. Okay? It's especially if you have money. If you have no money saved, this is going to be a nice exercise. And look at all those other people losing. But it's a bad day for markets. When you have big days like this one, the only explanation is, hey, you can talk about the coronavirus and how it's causing it, is there's been a sudden shift in risk premiums. And you can see why risk premiums can shift. They can shift on small things, they can shift on big things. A terrorist attack, risk premiums can change. But the bottom line, what I'm laying the foundations for, is how we estimate equity risk premiums then has to reflect that reality. In other words, if you're estimating an equity risk premium that stays the same no matter what happens, it's not a good estimate. It has to reflect the fact that the price of risk out there changes constantly. So this, let's hope this example doesn't play out to be a real world example by the end of today. If you were to ask exactly the same question, or if I ask the same question and today is a horrifically bad day for the markets, and tomorrow I came back and said, how much of a premium would you demand over and above? So remember the same example, you're 3% guaranteed, but now you've had one really bad day. How many of you would demand a higher risk premium after this event? Why? Because you got a reminder of what risk really means, right? I mean, often you need that, okay, this is what risk is. How many would demand a smaller premium? Nobody? So you all talk that contrarian talk, but you can't walk the contrarian walk, right? You know what the essence of being a contrarian is, right? If the market is down 25%, it must be cheaper today than it was yesterday, which is another way of saying, look, I'd be more willing to buy the stocks if they were 25% cheaper. As I said, in the abstract, everybody's a contrarian. So I can be a contrarian. And I tell people, the real test is, when you get out today, I want you to get online and take all of your remaining savings and buy the S&P 500 index. You know how difficult that buy, but so if you're going to, it's going to, your hands are going to be paralyzed. Because when markets are dropping, it is really difficult to go against the crowd. But if you truly are a contrarian, you could argue that maybe your risk premium will be lower if stock prices have come down. That's the essence of margin of safety, is when prices are lower, stocks become better investments. What I'm trying to say is risk premiums change constantly, and we need an approach that captures that shift. So I'm going to give you 3 different ways of estimating the equity risk premium. And I'm going to abandon 2 after I've done the 3, but you might hold on to one of those 2. The first, so when you look at estimating risk premium, the first is we can survey people, just like I did with you, and ask you, what do you want as a risk premium? And there are people who do this on a continuous basis. They survey individual investors, portfolio managers to see, and we're going to see what those survey premiums look like and why almost no one uses these survey premiums in practice. Second, we can look backwards, right? So when I ask you, what will you make on stocks relative to something risk-free, you're not starting with a fresh slate. People have done this for 100 years, 150 years. If I showed you what historically people have made on stocks versus something risk-free, you get what's called a historical risk premium. And you say, look, if that's what people have made historically, that's what I will make in the future. This is the standard approach most people use to get risk premiums. I'm going to talk about why I find myself uncomfortable using this approach, and you can decide for yourself whether you're okay with it. The third approach is what I'm going to call a forward-looking or an implied premium, where I'm going to back out based upon what you pay for stocks, what the risk premium is. And I'm going to title this, Watch What I Pay, Not What I Say. Right? So if you ask me what the risk premium is, I can give you 10%, 18%, I can make up any number. But when I pay for something, I'm actually sending a signal to the world of what my risk premium should be. I'll back it up because you're saying, how the heck can I back it out? It is actually not that complicated. We do it in the bond market all the time with the yield to maturity. I'm going to do something similar for stocks. So let's start this process with survey premiums. In survey premiums, as I said, you survey investors. You ask them what they think stocks will do over the next year. So let's take an example. Let's suppose this was the entire market, and I went around and said, what do you think stocks will do next year? And what do you think? So as I'm done, let's say I come up with the number 7.5%. That's what you've decided stocks will do over the next year. If you think stocks will make on average 7.5% next year, and the risk-free rate is 1.5%, it's actually now down to 1.35% today, now 1.5%. Your survey premium is 7.5 minus 1.5, or 6%. The question is, I can't survey everybody in the market, so how do I decide who to survey? I'll give you some subsets of investors that have been surveyed, and why with each group you might run into issues. There used to be a survey that the Securities Industries Association used to do with individual investors, randomly sampling 5,000 individual investors. They stopped doing it in 2004 for a very simple reason. What they discovered they were getting were hopes, not expectations. You go around asking an individual investor, what do you think stocks will do? And in your mind, you're doing the mental math saying, I need to retire 2 years from now. Stocks have to go up at least 20% for me to do that. So I'll say 20%. You're not getting an expectation. So they gave up because then Merrill Lynch does a survey of institutional investors. They still continue to do it, though somehow magically the number has become non-public for the last 4 years. So these are big portfolio managers. They control lots of money. So you're saying their thoughts matter. They still do only 1-year surveys. You're saying, why don't they ask them what stocks will do over the next 5 years? Because portfolio managers are unwilling to even answer that question. So these numbers are updated. But what Merrill Lynch is discovering is these numbers are reflections of history. So if stocks have done well in the previous year, portfolio managers seem to expect high returns. If they do badly, so you're getting a signal of what stocks have done recently. Campbell Harvey and John Graham, who are professors at Duke, do a survey of CFOs. Very different group, right? So why would CFOs care about risk premiums? CFOs use risk premiums to come up with hurdle rates for companies. So if they demand a higher risk premium, they're setting a higher hurdle rate. That number they've tracked every year. I have an update on my website. It's about 4% right now. And CFOs seem to be building about a 4% premium into their hurdle rates. That number is very sticky, doesn't change very much. Why? Most CFOs are old accountants, and accountants just don't like to change things very much. So basically, they just stay around the same number. It takes a lot for them to move. Then Pablo Fernandez, who teaches in a Spanish business school, surveys equity research analysts around the world. So what are you using? Because analysts, if they're doing discounted cash flow valuation, are using it. And that number is all over the place depending on which country. But that number on average was 5% in 2011. That number is now about 5.5%. And perhaps the most useless survey of all, Pablo also surveys academics. Why useless? What did I say your risk premium is weighted by? How much money you have. But in a sense, there might be an outsized influence here because these analysts might be taught by these academics. So the academics say 4%, it might feed into whatever they're using. So the bottom line is these survey numbers are all over the place. They're sticky. They're more reflective of the past than expectations for the future. And maybe that's a reason nobody uses survey premiums in actual computations of cost of equity. There's one sector where survey premiums still tend to be used, and that's real estate. Cushman and Wakefield, this outfit, real estate based outfit, actually does surveys of real estate developers around the country. And they ask them, how much would you demand as a premium over the, they don't even ask it as a premium. How much would you demand for as a return when you invest in residential or commercial buildings? And they actually break it down by region. You can go by region. And this is the cap rate number that you see by region. It's the only place where survey premiums have had some stickiness, but even there, as REITs and more public real estate companies enter the fray, those numbers are starting to kind of give way as well. So the bottom line is you can ask people about equity risk premiums, but the numbers you get tend to be either stale numbers because they reflect the past, or numbers that are, that really are more hopes than expectations. So at least I don't know of anybody who uses a survey premium in a cost of equity calculation. Which brings me to historical premiums. You're saying, what's a historical premium? Let's take a very simple example. Let's suppose I took the last 50 years of US equity markets. Can I get historical data? Yes. It's trivial. You can download from lots of data sets. And then I looked at 50 years of T-bond returns. Right? So let's say I made 7% investing in stocks over the last 50 years, 3% investing in T-bonds. I subtract the 3 from the 7. I get a historical risk premium of 4%. Simple, right? But when I use a historical risk premium, I'm making a leap of faith, which is that the future will look like the past. It's called mean reversion. It's amazing how much of investing in corporate finance is built on mean reversion, that things will revert back to the way they used to be, and with good reason. Mean reversion tends to be a pretty strong force. It's saying that's what I've earned in the past, that's what I'm going to use in the future. Okay? So you're assuming that the risk aversion of investors is not changing in any, so it could change year to year, but it reverts back to what it used to be. And that the average risk investment is staying roughly the same over time. So if I did this over 10 years, you might say, what's the big deal? But if I do this over 100 years, think about the average risk stock in 1920. Probably a railroad, right? Because railroads were pretty much 50% of the equity market. And the risk aversion of the average investor, remember less than 5% of Americans were invested in the stock market then, and they tend to be really wealthy investors. I'm assuming that hasn't changed over time, and that's one of the first things you got to get over. Is that going to be okay? Am I assuming something that's unreasonable? So let me show you the numbers, and you're going to very quickly see why historical risk premiums are not facts, but estimates. If you ask me what the historical risk premium is for US equities, I could give you 12 numbers, and that's just to start. 12 different numbers ranging from 3 to 12%. You're saying, how can you call all of these historical risk premiums? Because first, it depends on what slice of history I look at. So this is actually a data set that I update on my website at the start of every year. So this is through the start of 2020, including the 2019 data. I could go all the way back to 1928, which is pre-Great Depression. I could go back 50 years. I could go back 10 years. I could go back 20 years. In fact, I could make this table 10 rows long and have 10 different time periods. And depending on the time period, I can get different risk premiums. So that's the first reason. Second, if you ask me what's risk-free, I can compare to short-term governments, which is a short-term risk-free rate, or long-terms, I get different risk premiums. The risk premium tends to be higher when I use T-bills as opposed to T-bonds, because term structures in the US have been upward sloping. T-bill rates are usually lower than T-bond rates. So when I compare the premiums there. And third, it even depends on how I compute my averages. You think there's only one way to compute an average. You take 80 numbers, you add them up, you divide by 80, you get an average. That's a simple average, an arithmetic average. But money compounds. You know what I mean by compounds? Basically, you make 50% in year one and 15% in year two. So when you look at what your returns will be over time, you get a compounded return. I'll give you a very simple illustration to show you the difference between arithmetic and geometric averages. Let's say you invest $100 in a stock. It doubles next year. It goes to 200. And the year after, it drops back to 100. How much money do you make on this stock? You started at 100. You ended at 100, right? The bottom line is you made nothing. Through the magic of arithmetic averages, I'm going to convince you that you actually made a 25% return over the 2 years. Work out the math. First year you go from 100 to 200, that's a 100% return, right? You go back from 200 to 100, it's a minus 50% return. 100 minus 50 is 50 divided by 2. Your eyes are fooling you. You think you've made no money, but you've really made a 25% return. You know, until the early 70s, mutual funds were allowed to report averages the way they wanted to compute them. And they would consistently report arithmetic averages. Say, look, your portfolio looks like it hasn't moved, but you're just missing the returns you're making. Your actual returns were 12% a year. So depends on the time horizon, depends on T-bills or T-bonds, depends on how you compute averages. And the numbers can be all over. And I don't trust any of these numbers. And here's why. Remember in statistics, whenever you compute an average, what are you required to report in brackets below your average? Your standard error. Basically tell the word, hey look, the average weight in this class is 153 pounds, but by the way, the standard error is 30 pounds. Why? Because people need to be aware of standard errors when they make a judgment. You know that you can drown in water with an average depth of 6 inches? I'll give you a lake and say average depth is 6 inches. You can't swim. He says average depth is 6 inches. I'm just going to walk into the lake. What I forgot to tell you is there are portions of the lake where it's really 16 feet deep. Small consolation after you drown, say, look, I forgot to mention the standard error. But we do this consistently in finance, right? We report averages. We act like they're facts. So when you look at these numbers below, those are my standard errors. If you're going to use a historical risk premium, in addition to getting over the hump of mean reversion, if you're going to use it, here's my suggestion. Go back as far as you can. That sounds absurd. I'm asking you to go back to 1928. You're saying why? Look at what happens with standard error as you go to shorter time periods. If you use a 10-year risk premium, your standard error is almost 5%. That's almost all noise. So when you report 10-year, You said over the last 10 years, stocks have done better than T-bonds. I said, so what? It tells me absolutely nothing. Stocks are so incredibly volatile that you need, by some estimates, 250 years of consecutive data in a market that doesn't change for you to trust it. Good luck with that. Because in the US, you have data going all the way back to 1871. Robert Shiller has that on his data set in Yale. But the problem is in 1871, the US was an emerging market. It was coming out of the Civil War. It was just starting to grow. If I bring the data, it looks like I have a lot of data, but the market itself is shifting. So the numbers are incredibly noisy, so you need to go back long term. Second, be consistent about what you call risk-free. The last session I talked about how in corporate finance and valuation, because most of the stuff we do is long term, I'm going to stick with a 10-year bond rate, if you remember. So if I've decided to do that as my risk-free rate, the premium that I look at is the premium over T-bonds. So I want to go back as far as I can. I won't look at the premium over T-bonds. And if you ask me which premium should I use, the arithmetic or geometric average, think about how this premium is going to play out in your analysis. You build it into your cost of capital, right? And then you use it to discount cash flows in a capital budgeting project. You discount year 1, year 2, year 3, year 4, and think of what happens to your discount rate as you go through. It's going to compound. Given that you're using this in a hurdle rate that's going to compound over time, I want a long-term number. I want a number over T-bonds, and I want geometric. So if you ask me to pick a number, I'm going to go with 4.83% as the historical risk premium from this table that I trust the most. But even that number that I trust the most comes with a standard error of 2.2%. Remember in statistics, if I give you a standard error of 2.2% and an average of 4.8, and I asked you for a range on the equity risk premium, your true risk premium could be anywhere from 0.4%, minus 2 standard errors, to 9% or 9.2% plus 2 standard. So basically what I'm saying is your true risk premium in the US based on a 100-year history, or close to a 100-year history, is somewhere between 1 and 9%. Fat lot of good that does you. Historical risk premiums are not just backward looking, they're noisy and they will keep shifting on you. And most people, we ask them, why do you keep using historical risk premium? Because that's what 95% of the people who use, and that's how I was taught, corporate finance, use the historical risk premium. They'll say, what choice do I have? Because all I have is data from the past. But I think you do have a choice, and we'll come back and set it up. And to understand this third approach, here's what I want you to think about. When you tell me how much you pay for a risky asset, whether you like it or not, you're giving a signal of what your expected return in the future is. And I'm going to use a much simpler analogy to bring this home. Think of the bond market, right? You take a typical coupon bond. You have coupons for the next 10 years. Let's say it's a 10-year bond, and a face value at the end of the 10th year. You don't control the coupons. You don't control the face value. The only thing you control as an investor in the bond is what price you pay for the bond. So let's say I can observe that price. I observe the coupons and the face value. In the bond market, I can back out based on the price you pay what interest rate you will earn on the bond, right? It's called the yield to maturity. It's that discount rate that makes the present value, the cash flows in the bond, equal to the price of the bond. So if the company that issues the bond gets into trouble, you see a big news story that they're in trouble, you still don't control the coupon and the face value, but what do? You pay less for the bond. The price of the bond becomes your mechanism for you to reflect fears about the company. And so basically when the price drops, the yield to maturity goes up. You think that's a bond market. We're talking about the stock market. How would I do the same thing? When you buy a stock or a collection of stocks, let's say the S&P 500, instead of coupons, what do you hope and pray you will get as cash flows? Dividends. And in the US, increasingly, as we will see, a portion of your cash flows come in the form of buybacks because that's cash returned to stockholders as well. It's just a different form of returning cash. I can't tell you what it will be for the next 10 years, but I can tell you what it was last year. And here's where you have to make a leap of estimates. Basically, what you do is you take last year's cash flow, and if you can somehow estimate how much these cash flows will grow in the future, you can end up with expected cash flows for the future from buying stocks. It's a little more difficult than coupons because those are fixed. I can observe what you paid for stocks. I have the expected cash flows. What can I do? I can back out from this what your internal rate of return is. In a sense, that's your expected return on stocks. No matter what you tell me you want to earn, that's what you price stocks to earn. I subtract out the risk-free rate from that. I've got what's called an implied equity risk premium. So let's try this as of November of 2013, because many of the numbers for my companies come from November of 2013. November of 2013, the S&P 500 was at 1,756.54. So that's what you paid for stocks. The cash flows leading in to November of 2013 were 82.35, but a big chunk of them came from buybacks. So about 60% from buybacks, 40% from dividends. So here's all I know. I know what you paid for stocks. I know what the cash flow was in the last 12 months. I brought in an estimate for the future, and here I'm playing a little bit with fire because we know analysts collectively sometimes have bias. But to try to control that bias, I basically looked at estimates for growth, and these are called top-down estimates. You're saying, what are you talking about? This is the S&P 500. One way to get estimated growth for the future is go and look at what analysts are estimating as growth for each individual company, because analysts track each company, and then take a weighted average. The problem with those bottom-up estimates is we know analysts, when they project growth for individual companies, tend to be biased upwards. Why? Because they sometimes forget the rest of the world even exists, right? It's human nature. You focus on your company, you give it a higher growth rate because you're listening to all these great plans for the future. There's going to be machine learning, there's going to be big data. You forget that everybody has access to machine learning and big data, and that they all might act. So if you use bottom-up estimates, for instance, November of 2013, the bottom-up estimate was 10.5%. So the top-down estimates come from analysts who track the entire S&P 500. They live very boring lives. They actually track the aggregate earnings in the index, and they try to forecast based on macro variables what the growth rate will be. Their growth rates tend to be consistently lower. Are they always right? No. They're wrong, but they're wrong in different directions, which is what you should expect with any reasonable estimate of future earnings, is they sometimes overestimate, sometimes underestimate. November of 2013, that growth rate was 5.59%. See where I'm going to go? I took the 82.35, grew it at 5.59% for the next 5 years. And then I run into a problem. With a bond, there's a finite maturity. I can stop. With stocks, I have to keep going and going and going forever. I can't keep doing this forever. Not to mention the fact that the growth rates I got were 5-year growth rates. To the end of the 5th year, I said, these are the 500 largest market cap stocks in the US. The growth in their earnings has to track the growth in the economy because earnings can't keep growing at a rate faster than the economy. So at the end of the 5th year, I had to give them a growth rate equal to that of the economy. And here, you run into a challenge, right? If I ask you what the expected growth rate in nominal GDP will be next year, and if you take the 50 best economists in the country, ask them, you know how incredibly bad they are at making this forecast? And if I ask them what this growth rate is going to be for forever, which is what I'm asking there, you might as well ask the doorman in your building, and you'd probably get a better answer. So I don't even want to go estimate. So I want something I can use as a proxy. So I'm going to tell you what I use as a proxy. And this is something you're going to see me do in this class over and over, is when I want to project a nominal growth rate in a mature economy, I'm going to use my risk-free rate as my proxy for that growth rate. And think of why. If you think about all those risk-free rates you saw on that graph, one component we said was expected inflation, right? And we said it's in the risk-free rate. So if you have high expected inflation, the risk-free rates will be high. But if you think about Econ 101, when you look at a risk-free rate, there's expected inflation and an expected real interest rate. That's what makes up a risk-free rate. I'm going to make a leap of faith. Lots of leaps of faith I'm making today, but one more leap, what's the worst that can happen? I can fall into the abyss, but now I won't think about it. I'm going to assume that in the long term, your expected real interest rate and the expected real growth rate have to converge. And let me explain my rationale. If you think back to your econ class and you think about how expected real interest rates were explained, the way they were explained to me is if you borrow 100 apples, I don't know what this thing about apples was then, and you offer to return them a year from now, it can't be the same apples, obviously, they'd be rotten, but you'd have to return 102 apples. In other words, anytime people talk about real interest rate, they talk in terms of goods and services because it's got nothing to do with currency. You've got to return more in substance. So if I promise a 7% real interest rate collectively in an economy, then my real growth rate has to be at least 7%, otherwise I'm going to have a problem. The same thing applies in the other direction. So basically, over very long time periods, and that's what we're talking about here, forever, real interest rates and real growth rates have to converge, which is a very fancy way of saying your best estimate for the nominal growth in GDP in an economy is the risk-free rate, which should be terrible news if you're from Europe. Because what did we just say the risk-free rates were in the euro? Minus 0.5%. If you buy into that, the signal you're getting about future growth in nominal terms is a terrible one. Okay? That's why low risk-free rates are kind of a mixed blessing. When people say low risk-free rates are low, how come stock prices are not shooting up? Because those low risk-free rates carry other signals as well. So here's where we are. At the end of 5 years, I assume it'll start to grow at the risk-free rate, which at that time was 2.55%. I have everything I need. I have the price you paid. I have the expected cash flows in the next 5 years. At the end of the 5th year, I'm assuming these cash flows grow forever. So I'm capturing both the cash flows you get from stocks, and that last term is the price appreciation component, how much stocks will go up. The only number I don't know is the discount rate. I'll solve for the discount rate. If you were doing this by hand, you know the only way you solve for it? You can't use the IRR function in your calculator because the last number is actually going to be a function of it'll have to be trial and error. You'll have to start with 7, you get to a higher number, you try 9. Thank God for Excel, because in Excel you can use the solver function, which does the same trial and error, it just does it a lot faster than you do it manually. And it comes back and says 8.0. You're saying, what does that even mean? If you bought stocks in November 2013, I don't care what you hoped you would make, what you prayed you would make, what you thought you would make, given how much you paid for stocks, you could expect to make 8.04% a year in the long term. I'm almost there. I subtract out the T-bond rate on that day. The difference that I get is about 5.5%. November 2013, stocks were being priced in the US to generate about 5.5% more than the risk-free rate. That becomes my implied equity risk premium. So if you think about the choice I face is in November of 2013, I could have gone with the historical data, which at that time would have given me an equity risk premium of 4.2%. That's a number I've updated through 2019 to become 4.8%. But in 2013, the choice I faced was, should I go with the status quo, the conventional wisdom of looking backwards, in which case I'd get 4.2%, or should I go with what the market is telling me, which is 5.5%? And to me, it was no contest. I went with the 5.5% for a couple of reasons. One is, remember that standard error I showed you on the, and you can see it here as well, 2.33%? That's in the historical premium. Is there a standard error in my implied premium as well? Go back and look at the page. Yeah, right, the growth rate could be wrong. But if you work out the standard error in the growth rates and the cash flows, the standard error you get is about 0.2%. So I could be wrong, but the amount I can be wrong with on my implied premium is going to be far smaller than the amount I'm going to be wrong with the historical premium. So that's my statistical reason. I'll give you my economic reason. What do we say we assume when we use a historical premium? Mean reversion. What does that mean? We assume things will revert back to the way they used to be. In other words, we're assuming that we're reverting back to 1981 America over and over again. This is like Groundhog Day. And to me, 2008 was a breaking point. It was a reminder to me, if we needed one, and we all needed it, that we no longer lived in a global economy where the U.S. was the center. The U.S. is still the largest economy, but it's connected to so in a sense, it's a reminder that mean reversion might be a very dangerous assumption to make, not just in terms of equity risk premiums. I think it's a dangerous assumption when you use PE ratios. So when people say stocks are overpriced, look at the Schiller PE from 1871. My reaction is, are you out of your minds? You're making a comparison to a history that might have passed us by. So for those two reasons, I have stopped using historical premiums completely in both corporate finance and valuation. The reaction CFOs have, but my premium could change every day. Yes, get used to it. A project I take at 9 a.m. could be terrible by 5 p.m. Could happen. If your projects are that close to the edge that one day can make a difference, maybe you should think about that when you decide what to take. It's a world we live in of much more volatile risk premiums, and the implied premium captures that. Question?
How many companies do not pay any dividend buybacks?
In the S&P 500, about 30%. Across the entire market, about 60%.
So, I mean, when you do that computation, how do you do
Why do those companies not pay dividends? You can't just hold dividends at zero and then keep. Where do you think that growth is coming from? No, it's not just the price. Where do you think that growth is coming from? It's not coming from the big dividend paying stocks like Verizon in there. It's coming from the fact that you have some companies in there like Facebook that are growing 12% a year. So when you look at that equation, that 5.59% growth reflects the composite growth. So you can't just say, let's raise the dividends for the companies that don't pay dividends and leave the growth where it is. So if I picked a group of big dividend paying companies and did this computation, I shouldn't expect to get a much higher equity risk premium because what I get in dividends, I will give up in growth. And the bigger problem in the US is there are companies that can pay dividends like Apple. That they pay dividends but they do buybacks so that's why you have to include the buybacks in the process because otherwise you're missing a big chunk of how cash flows get returned. Yes?
Why is it that we don't use the free cash flows to equity shareholders?
You could. The question, and I know for a lot of people here, you're saying, because we haven't come to free cash flows equity class, let me lay the foundation. With companies, you can observe what they pay, which is what I'm doing with dividends and buybacks. Or you can estimate what they could have paid. A free cash flow equity is like a potential dividend. It's what they could have paid. You're saying that's going to be tough. It's actually very easy to compute. You take the statement of cash flows, you subtract out all your capex and debt payments. What you're left with after you've covered every other need is your free cash flow equity. So you could do this entire calculation with free cash flow equity. I'll tell you what stops me. There are about 16% of the S&P 500 companies that are financial service companies. And with financial service companies, estimating cash flows becomes a nightmare. And here's why. You start with earnings, which you can get for a financial service company. But to get to free cash flow equity, what do you need? You need net capex, change in working capital. And when you go down that path for a financial service company, you will drive yourself crazy because estimating those numbers becomes really tough to do. So for some markets, especially emerging markets, I do compute the free cash flow equity because there using the dividends is going to give you too low a cash flow. But in the US, I think of the collective cash return, dividends and buybacks, as a rough estimate of free cash flow equity. So that's my argument. But if you really wanted to do free cash flow equity, you could do a calculation. You get a number very similar to what we're getting with the dividends and buybacks, at least now for the S&P 500. But that's a good choice as an alternative when you don't trust the dividends. Okay? Any other questions? Yes?
The first estimate where we took the cash flows from the entire all the companies
Right.
pay dividends and buybacks for S&P 500.
All companies, including the ones that have nothing, right? So basically, among the 500 companies, there'll be some companies that just pay dividends, some companies that just do buybacks, some companies that do both, and some companies that do neither. Yeah. Right. And it has.
The rate of growth for companies which actually pay dividends and do buybacks is lesser than the growth companies.
Yeah.
So won't that be an overestimate?
Why? Because I'm including the zero dividends and buybacks in the companies that have higher growth, right? So if I excluded the companies that pay no dividends and buybacks, my cash flows will be higher, but my growth will be lower, right? So the yield you get there. So you can't just keep the cash flows fixed and take out the non-dividend paying companies. Because it's not going to be fair to just look at so I'm looking at the collective cash flow of both high growth and low growth companies, and I'm also looking at the collective growth rate for both. So whatever makes one number low will make the other number high, and that's why you can't selectively change one of those numbers, because that would be unfair. Right? So that is for the US. So from this point on, when you see my equity risk premium in November of 2013 for US companies, you're going to see me use 5.5%. You're saying, why not 5.49%? If you want to make a federal case of 5.49 versus 5.5, I'm willing to give you the 5.49. It's close enough to 5.5. It makes my calculations a little more straightforward. And for emerging markets, we're going to talk about the way I'm going to come up with equity risk premiums. And we talked about this last session. Remember, we took the default spread. Did we do it last session? Maybe not. No. So we're going to talk about estimating emerging market equity risk premiums. So let's now turn our attention. So this is the US. US, you have luxury of choices. You can go back 100 years. You can do historical, arithmetic averages, geometric averages. But for most markets outside the US, this is not even a choice. And a few months ago, I got an email from a Vietnamese analyst who's valuing a Vietnamese company. And he said, look, I've been using your book to, so this is how the guilt kicks in. I've been using your book to do my valuation. And I want to make sure I haven't screwed up badly. So here's what I did. Can you take a look? So I take a look. And he's done a pretty good job. And he's got a risk-free rate. And I look for the one number, though, that made me pause was he had an equity risk premium for Vietnam. How many years of historical data do you think you have for Vietnam? If you're lucky, maybe 5, 7. He found a way to scrabble up to like 8 years of data. And he said, I computed the historical equity risk premium for Vietnam to be 9%. Sounds reasonable. And he said, and he'd used it. And I just emailed him back and said, did you compute the standard error in that number? And you know what the standard error in a 7-year historical data set would be? It's probably about 11%. So you take a market like Vietnam, what you have is pure noise with 7 or 8 years of data. And with many emerging markets, you can take 20. You think, I mean, in our minds, 25 years sounds like a long time, right? But with equity markets, 25 years, 30 years, 50 years is like a drop of time. And basically, it's just not enough data there. So if I came to you with a Brazilian company and say, I need an equity risk premium, you have two choices. You can say, come back in about 75 years. I'll have enough historical data to make the judgment, or try to do something today. Let's do something today. So I'm going to give you two ways in which you can compute equity risk premiums for emerging markets. And remember, this is actually true even for European markets, because even in European markets, most of them had a break during the Second World War. They didn't have trading all the way through. So you don't have uninterrupted history, which means even if you take Germany or Austria, you start with data that is a little spotty between 1940 and 45. So this is a problem that's almost global. Outside of the US, the notion of using historical risk premiums becomes even more dangerous. So the question becomes, how do I estimate the equity risk premium for a market that doesn't have a lot of history? Here's the first, and this is perhaps the status quo in how investment banks and analysts estimate equity risk premium for other markets. They start with the US equity risk premium. Where do they get it? Either by looking at historical data or making up a number. So let's say that number is 5 or 6, you start with that base. Then they look up a measure of country risk that's observable that is in percent. And you know what they latch onto? Remember that default spread we used to clean up risk-free rates, where I looked at the rating for the country and I came up with the default spread to kind of come up with the risk-free rate in Brazilian real. They take that same default spread and they add it to the US equity risk premium, and that then becomes the equity risk premium for that country. So as an example, if you look at India, China, and Brazil, based on the rating, there's my default spread. That's exactly the default spread I used to get the risk-free rates. My US equity risk premium is 5.5%. I add the 5.5% to that number. I come up with an equity risk premium for each country. If you don't like to use default spreads, remember I said that there's a sovereign CDS market. We can get a market-based number. There are the market-based spreads, and I get equity risk premiums based. And when we talked about risk-free rates, I said make a choice, stick with it. So if you decided to go with the default-based spreads there, stick with the default-based spreads here as well. If you went with the sovereign CDS spreads there, stick with the sovereign CDS spreads here as well. But basically, you're taking that CDS or default spread, adding it on. So if you walk into Goldman Sachs or Morgan Stanley or McKinsey and you look at equity risk premiums for other countries, this is how they do it. They take the US and add a default spread. And the one thing that troubles me about this is the default spread is what you're charging for buying a government bond issued by that country, right? So when I say the default spread for India is 2.25%, that's the spread you're charging for buying an Indian government bond because you feel it's risky. But that's not what you're buying here. You're buying Indian equities. So let me ask you a generic question that's always troubled me. Are equities generally riskier than bonds or safer than bonds? Riskier, why? Because you're the last guy in line, right? So if the guy in front of you is charging 2.25%, I would expect you as an equity investor to charge a little bit more or a lot more than 2.25%, which leads you nowhere, right? You're saying, how much more? I'll give you the way in which I try to estimate how much more. I look up two numbers. So in the case of Brazil, I look up the standard deviation of the equity index, the Bovespa. Let's say it's 21%. And then I look up the standard deviation, that Brazilian government bond. Let's say that's 14%. You take the ratio of those two numbers. It looks like equities are about 1.5 times more risky than bonds. Let's set up an algebra problem. You bought the government bond. The spread you charged was 2%. So that's what you would have charged to buy the bond. Equities are 1.5 times more risky. So I would assume you would charge 3% for equities because I know we're trusting these standard deviations to be good measures of risk. And I'll talk about how in practice I run into issues with this for many countries. But if you can look up a standard deviation for both equities and government bonds in a country and both are reliable, the ratio of those numbers should tell me how much more my equity risk premium should be. So my risk premium for Brazil using this approach would be 8.5%. And extrapolating, I can get China and India using the same approach, looking up the standard deviation of the equity index, the standard deviation of the government bond. So it's not a big jump from what people traditionally do. All I'm doing is adjusting the default spread for the fact that equities are generally more risky than bonds. So let's list, so if I were to describe this approach from scratch, here's what I do. I compute an equity risk premium for a mature market. The mature market that I'm most comfortable doing this is the US, partly because the data is richest, I have a long time period that I can look at. You can either go with the historical or the implied. I told you my bias is to go with the implied premium. That becomes my base. So that's step one. Step two, I come up with a measure of default spread for each country. And here's where it gets simple if you're a AAA rated country. If you're a AAA rated country, what's Moody's telling me about the country? There's no default risk, and if there's no default risk, I give you the same equity risk premium as the US. And my rationale is very simple. If you think of AAA rated countries as mature economies, you cannot have different equity risk premiums for different mature markets for a simple reason. If I told you the equity risk premium in the US is 5.5%, but in Germany it's only 3%, given that capital can flow across markets, investors would leave Germany and come into the US and things should equate. So all my mature markets, and I'm using a very sloppy definition of mature, AAA rated countries have the 5.5% premium. If you're not AAA rated, I look up the default spread for your country, either based on your rating or a sovereign CDS market, and I scale up the default spread for how much riskier equities are to bonds. And I have an equity risk premium for your country. So here's what the world looked like to me in November of 2013. I'll give you the updated version of this page in a minute. So basically, these are equity risk premiums broken down by geography using exactly the approach. So let's start with the US, 5.5%. Remember where that came from? That was my implied premium, November of 2013. You're saying, why is Canada's premium the same as the US? Right? It's not because I'm taking some parochial and say Canada is another state of the US, so don't take it personally if you're a Canadian. It's because you have a AAA rating. And that's why Germany has a 5.5% premium, Australia has a 5.5% premium, and Singapore has a 5.5% premium. It's the only part of Asia that now has a AAA rating. So if you're not AAA rated, that red number captures the additional risk premium. And I estimate it by taking your default spread and scaling it up. So this is my breakdown of the world. And you're saying, with each region, I've actually also computed a regional equity risk premium. That regional equity risk premium is a weighted average of the equity risk premiums of the countries in the region, weighted by GDP. Why? Because if I'm doing Africa, Nigeria and South Africa should be weighted a lot more than Ghana or the Republic of Congo, or whatever else I have in there, because they're much smaller economies. If I'm doing Asia, China, and India should be weighted more than Vietnam or Cambodia. So basically it's a reflection of the fact that you asked me for a regional premium. You think, why would I need a regional premium? You're going to see in a minute that when you start to look at companies, companies don't always break down what they do by country, they break it down by region. So I need this picture of the world, even though I might be looking at Brazilian companies. You're saying, why don't you just keep it with Brazil, India, China, and the US? After all, your companies are from those countries. Here's why. Your risk as a company doesn't come from where you're incorporated. That would be a very nice, if I could do that for Disney, I'd just use the US equity risk premium. It's incorporated in the US, its headquarters are in Burbank, California. So you could say, hey, it's a US company, I'll use the US equity risk premium. But Disney is not a US company, it's a global company that through the accident of history happens to be incorporated in the US. And if you break down, if you look at their breakdown of revenues, they break their revenues down by region. You have to take the information you have, not look for information you wished you had. Many of you, when you look at your companies, will see a breakdown of revenues. And many are going to say, I wish they'd done this better. I'll give you, US companies are among the worst culprits when it comes to this. Typical US company will break its revenues down saying, we get 72% of our revenues in the US, 28% from the rest of the world, right? That's a pretty shoddy breakdown. But you know what, that's all you get. So here's what you do. You take 72%, you give it the US equity risk premium, take the remaining 28% and give it the equity risk premium for the rest of the world, which you, the GDPs and the risk premiums for the rest of the world it's not something you want to do, but it's something you have to do. The equity risk premium for the rest of the world at the start of 2020, I'll give you that number. So if any of you have a rest of the world, you can attach this number to it. But basically, my equity risk premium for Disney reflects where it does business. And I did this for the rest of my companies. And as I break this down, you're going to see very quickly why the coronavirus can affect so many equities in so many parts of the world. Right? You take Bookscape. Thank God for small blessings. Bookstore in New York City. I said, unless all the people buying your books are from Sweden. I don't know why that would be, but if that is, then you might have to worry. But this, I just gave them the US equity risk premium. Look at Vale, Brazilian company, right? But what's its biggest market? China. Why? Because you sell iron ore for construction, and if you think about the infrastructure, the building in China, the biggest market for Vale is China. Tata Motors, that actually is now, China is now the largest market. You're saying, I haven't seen any Tata cars in China. Which portion of Tata Motors do you think is accounting for that? It's the Jaguar Land Rover. I don't know what the Chinese are doing driving big Land Rovers around, but somehow that's, so you go through company after company, you see China up there. So when China has issues, you're going to see this percolate not just through Chinese stocks, but through the rest of the world. It's not just supply chains. I know that's the story right now. It's where you get your revenues, where your growth is coming from, and you see this with company after company. So basically, with every one of my companies, my equity risk premium is going to reflect a weighted average of where they do business. And I'm dependent on the company revealing this to me. And I've used revenues because often that's the only information they give. But if you feel that in your company, where they produce the good matters more than revenues, you can weight it based on where their factories are. And with oil companies or commodity companies, I will entirely look at where the oil or the commodity comes from, because I really don't care where you sell the stuff. It's all dollar-based commodity markets. But the bottom line is, I'm going to estimate equity risk premiums based on where you do business, not on where you're incorporated. Now, one final point about implied equity risk premiums. Until 2008, I used to compute the implied equity risk premium at the start of every year and use it through the entire year. And if you ask me, why are you doing that? My defense would have been, it's a mature market. In a mature market, equity risk premiums don't change that much. And in 2008, I've shown you the graph. Look at how little it changes. I no longer hold on to that belief because sometimes I think the facts will come in and you got to decide whether your beliefs are more important than the facts. the facts year came in the last quarter of 2008, during the crisis. So many, none of you were in markets during the crisis, but it was a truly scary period because it shook our faith in whether there were developed or emerging markets. Because between September 12th of 2008, which was the day before the Barclays collapse, the start of the crisis, I computed the implied equity risk premium every day. So if you think about the calculation, and I'm doing it every day, and I did it as I came into work every day because I used to live in New Jersey. I used to take the train in, nothing to do on the train, compute the implied equity risk premium. What else, yeah. What's the number that's changing? I mean, no, clearly you're saying how much can change? Think about all the inputs. You got cash flows, you got growth rates, you got risk-free rates, you got the level of the index. Remember the implied equity risk premium. So today is a big day for implied equity risk premiums. In fact, I will compute the implied equity risk premium at the end of today. I always do it after big days just to kind of calm myself down. I'm actually supposed to be on CNBC at 5:30 or something talking about Tesla. I have an idea that Tesla is not even going to be the topic of conversation. They're going to ask me a question I absolutely hate. What do you think about markets? I don't think about markets. I'm a healthy human being. They think I lie awake and say, what are the markets doing now? What are the markets doing now? But I'm going to compute the implied equity risk premium because this is the kind of day where you see the price of risk change dramatically. Whether it's a change that makes sense, rational or irrational, we can debate maybe a couple of weeks from now. But for the moment, it gives me a sense of why it's not changing because cash flows change today. You can say over the weekend of supply chains, you can make cash flow changes. You cannot get this much of an impact on prices unless the price of risk changes. So during this period, so the green line is actually my implied equity risk premium. The red is the S&P 500. So the stocks are collapsing. My implied equity risk premium is climbing. The implied equity risk premium started about 4.34%. There was a day in November where it hit 8%. It almost doubled in 2 months. This was not supposed to happen in developed markets. If this were an emerging market, you'd have said, hey, of course it can happen in Brazil. This was not supposed to. This is what made people so terrified in that last quarter, is you are seeing in mature markets, and across all mature markets, behavior that nobody had seen, probably since the Great Depression. And you know what it taught me? That I could never again compute the equity risk premium at the start of every year and use it for the rest of the year because equity risk premiums can change quickly even in mature markets. So since September of 2008, I've been computing the implied premium at the start of every month. So you go to my website, the front page, I give you the equity risk premium as of the start of February 2020. Okay. I'll give you at least a sense of what the January 2020 numbers look like, and I'll give you an update of what February looked like and what March will probably look like given that we're getting to the end of the month. Start of 2020, so this is what I did in November of 2013, updated through 2020. The S&P 500 was at 3230.78. You remember what it was at the start of November 2013? Like less than 1800, so it's been a good 6 years. So while you freak out about what's happening today, have some perspective. It's been a good ride. And maybe you need a little roller coaster along the way. But don't stop whining about a bad day. It's been a good overall time period, 3230.78. In fact, even after the drop, and I checked this morning, you know what the S&P 500 is at? It's at 3252. Sometimes all you need is step back and say, I started the year at 3230, I'm at 3250 now, what am I complaining about? That's what I'm going to tell on CNBC. They're not going to like it, no? But we tend to get so focused on what happened yesterday, what happened last week, that we're almost incapable of stepping back and asking, where does this leave me? If I just gone on a 2-month and 15-day vacation or 2-month vacation, I've just come back. So that was the level of the index. There are the cash flows in the trailing 12 months. 150.5. Or do you remember what it was in the November? That's an unfair question because nobody will remember that. Right? It was 82.35. Keep that in mind because you're going to, we have a much higher index, but we also have much higher cash flows. Big chunk of it's still in buyback, so that hasn't changed. The growth rate for the next 5 years has now dropped from 5.58% to 3.96%. People have become a little more sober about future growth. And the risk-free rate is now 1.92%. I do exactly what I did in November of 2013. I take the level of the index, I take the expected cash flows, I've solved for R, and that number is now 7.12%. Unfair question again. Do you remember what it was in November of 2013? 8.04%, that's good. So we've gone from 8 to 7.1%. So people are demanding a lower expected return on stocks. The T-bond rate was 2.55%, it's now 1.92%. That difference of 5.2% leaves me lower than where it was at 5.5%. But given how much stocks have risen, you're saying, how come the equity risk premiums have not collapsed? And there are two answers. One is the risk-free rate has become lower. The other is, if I'd left the cash flows at 82.35, this equity risk premium would be tiny. Cash flows have almost doubled over the last 6 years. The index has less than, so basically everything is in motion here. So in January 2020, at the start, my implied equity risk premium is 5.2%. And if you look at it with perspective, where does this number put us relative to history? I've been computing the implied equity risk premium in real time since the 1990s. So basically the start of every year, I do it religiously. First thing on New Year's Day, I have a very strange ritual on New Year's Day, is I compute the implied equity risk premium. And then I set it on fire. Okay? And pre the 90s, I actually went back and got the numbers, but I put myself in a time machine to do it. You know what I mean by it? It's not fair to compute an implied equity risk premium with the benefit of hindsight. So I went back to 1960 and said, if I knew nothing about what's coming afterwards, so I did this every year. So basically what you have here is the implied equity risk premium since 1960. And this graph, in a sense, tells you the story of U.S. equities for the last 60 years. They're the 1960s, incredibly stable period for U.S. equity risk premiums between 3 and 3.5%. The U.S. was the global economy. Okay. Then you get to the 1970s, something's really happening, right? Implied equity risk premiums shooting up. First, easy question. When implied equity risk premiums are shooting up, what's happening to stock prices? They're collapsing. That's, in fact, do you know what the Dow was in 1978? 780. 3 numbers. Think about it. 3 numbers on the Dow. Okay. Business Week ran a cover article saying stocks are dead, which to you should be a sign. Every time you get these articles, go buy stocks like crazy, because 1978, the implied equity risk premium was 6.5%, and you got one of the great bull markets of all time. End of 99, the implied equity risk premium in the U.S. was down to 2%. It's a peak of the dot-com boom. How many people in this class said they would accept 0 to 2%? One person, right? If we all stayed true to what we just signaled, at the end of 1999, the rest of us should be saying that equity risk premium looks too low to me, which is the same thing as saying what? Stock prices are too high. Anytime you make a statement about stock prices, you're making a statement about equity risk premiums. 2%, if you told me you were in a bubble collectively, you had a good basis for it, right? 2% is way too low relative to what I've been earning on stocks historically. We're hearing that same talk, and today again, the bubblers will be out in full force today. So I told you so. It's all coming. Get ready for the, whatever. But at the start of 2020, my equity risk premium is 5.2%. It's not 2%. I'm not earning a number that's low by historical standards. I'm earning a number that's pretty close to the middle or even the upper end of the distribution by historical standards. So am I worried stocks will collapse? You always should be worried stocks will collapse. That's why you have an equity risk premium. There's never been a time in my life where I've said, oh, I feel really good about stocks. And if I've ever hit close to that moment, usually bad things happen. Okay? But if you look at the cash flows, the growth rates, I mean, the 5.2% looks like a pretty reasonable premium. One final point about completing this process. So I have a 5.2% premium, start of 2020. My follow-up to computing the implied premium for the US is to get risk premiums at every other country. So you can see I have a fun first week of the year. So I do exactly what I did in 2013. I start with the US implied premium, that's my base. Then I look up the default spreads or ratings for every country where Moody's or S&P rates a country. Then I convert those default spreads into country risk premiums. Remember how I did that for Brazil? I looked up the Bovespa standard deviation, the government bond. I tried this for 160 countries, and I very quickly realized it would drive me crazy. Because for 130 countries, there are no government bonds traded. And for 20 of the countries with government bonds, I don't really trust the trading. This is not like the T-bond market, deep and wide. Now, it's shallow trading, liquidity not to be trusted, so I cheat. Rather than look up each country's equity standard deviation and government bond standard deviation, I look up the standard deviation in an index, two indices actually. One is an S&P index of emerging market equities collectively. And the second is an S&P index of emerging market government bonds collectively. So rather than look up each country, I look up what that ratio is for the indices. I get 1.18. So here's how it would work out. If I have a default spread of 2% for your country based on the rating, I'm going to multiply the 2% by 1.18. That'll give me 2.36%. And add the 2.36% to the 5.2%. I've got an equity risk premium for each country. So ready? This is what the world looks like at the start of 2020. Basically exactly what I did in November 2013, updated now to have the base premium be different, 5.2%, and the ratings that have shifted since. Of all the data that I have on my website, this is by far the most downloaded data in there. It's used in the strangest places. I've kind of given up on how it's used now. And I'll give you a couple of examples. A few years ago, I get an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand until I got this email saying, we're using your country risk premiums to set milk prices for New Zealand farmers. What? Who are you selling the milk to? Zimbabwe? I don't know. No. And usually the question is, how do you compute the risk premiums? And as you can see, it's not rocket science. I said, look, I don't bring any intellectual... They say, first they'll email, will you ask your team to contact us? And I said, the team is me. And I have no team. There's no intellectual firepower. I'm not collecting data on the countries. This is how I do it. So I go through the process. But once in a while you get an email or a question that you don't even know how to answer. My least favorite email of all time. April of 2009. I get an email from Lebanon. I'm pretty excited. I didn't get that many questions about valuation from the Middle East. I open it up and here's how it begins. You have destroyed Lebanon. I said, what? After 30 years of civil war in Hezbollah, I'm the guy who destroyed Lebanon? So what did I do? And the email was from a Lebanese business person whose business had been appraised for value, and the appraiser had used the equity risk premium for Lebanon off my website. Right now, Lebanon looks like it's 14, that number was 17.5% in April of 2009, coming right out of the crisis. See why this guy was pissed off? You put a 17.5% premium into your discount rate. Your discount rate goes to the roof. What happens to your value? It collapses. He felt he'd been gypped. It was all my fault. My first reaction was, take it up with your appraiser. It's not my problem. But then I decided that since the letter was from Lebanon, I should be a little more careful about how I responded. I said, it's not my fault. You see whose fault it is? Remind me again how I do this. I start with the US implied premium. Then I go to Moody's and I look up your rating. And if your rating is in the toilet, guess where you're going to? You're going there as well. And I said, it's not my fault, it's Moody's fault. And if you want an address for your GPS, here it is, 77 Church Street, New York, New York. Just enter it, do whatever you want. I have nothing to do with this. After I posted my 2020 numbers, I start getting emails from Moldova. So what do you have against Moldova? I said, I don't even know where Moldova is. It's somewhere up there by Russia somewhere. I have no idea. I haven't thought about Moldova ever in my life. Didn't like the risk premium I gave Moldova. Or somebody from Serbia emailed me last week saying, how come you're giving Serbia and Belarus the same equity? He was taking it very personally. We're not like Belarus. I say, okay, take it up with Moody's. I have nothing to do with this. You're both given the same rating. So there's zero firepower behind these numbers in terms of intellectual firepower. But one final point is saying, what are these numbers at the top? These are what I call frontier markets. You know what frontier markets are? I'll list out some of them, and you can see why they're called frontier markets. Sudan, Syria, North Korea. These are countries which have no ratings. Why do they have no ratings? Imagine working for Moody's, and your boss calls you and says, I have an assignment for you. We've decided to attach a rating to North Korea, and we are flying you out there. This is the kind of job you say, I don't need this job, I'm leaving now. So these are countries with no ratings. Until about 3 years ago, I did not have a country risk premium for these countries until I get an email from a Syrian businessman. There's actually one guy left in Syria, I think, running a business. Must be the last guy left. He says, I'm trying to compute a hurdle rate for my company. To which my response is, get your head screwed on straight. Is this your top priority? It wouldn't be mine. He said, I'm looking in your website for an equity risk premium for Syria. I cannot find it. Why? And I said, I went through. You don't have a rating. And that's what. Then he emails me back almost a minute later saying, so what do you expect me to do? I had a bunch of suggestions that I didn't want to give him. I said, you're right. I should be giving you a risk premium since you can't. So starting about 3 years ago, I started coming up with equity risk premiums. And here's how I did. There's a service in Europe called Political Risk Services, PRS. And they have a country risk score for countries like for Syria. So Syria's country risk score was 38. And they had 4 other countries with risk scores close to 38, 35 to 40. And 2 were rated. And I had a risk premium for those 2. So guess what I did? I took the average, attached to Syria, saying that is so unsophisticated. If you can come up with a better way of estimating equity risk from Syria and North Korea, I'd love to hear it. But I think I've got the world covered. So if you have a company that gets half its revenues in North Korea and the other half in Syria, I can give you an equity risk premium. The rest is up to you. You fly there, you run the businesses there. But this is the basis for computing equity risk premiums for companies, but I need the world in front of me because I don't know where you do business. Okay, so I will see you next session. Incidentally, if you get a chance and you picked a company, check the footnotes for where they get their revenues. This is like a 2-minute exercise, and you can use my equity risk premiums for that country to compute your average, but try to get that number started.
My name is Frank. So I have 2 questions about the Implied ERP. The first, you mentioned if you're going to talk with a new ERP by the end today, obviously you have a lower index level. But is the cash flow growth rate going to be updated that quickly?
That can't be updated that quickly. So you will lag because there will be a cash flow growth effect. So that 3-point-something% might be lower to 3.3%.
Yeah.
That effect is going to be a tiny part of this whole picture. So there's going to be a cash flow effect. Buybacks might be reduced because companies are worried about the future. Maybe Apple won't buy back as much stock this year because the China business is slowing down. That number can't be updated more than once every 3 months because that's when S&P updates the dividends to the buybacks. So I'll be watching the March 15th update to see if anything dramatic happens. And if it happens, you're going to see it show up in the April. So for the first 2 months, I might be overestimating the equity risk premium because I'm putting everything on the index and the T-bond rate. Okay. Remember, those 2 numbers are changing every minute of every day.
I see.
The cash flows.
So my thoughts are the reason why index has dropped so much because the market expectation of the future cash flow has dropped.
I don't think that's the reason. When you see this much of a drop,
So
the
it's
bigger
more of a
reason is
overreaction.
not an overreaction. It's that you're becoming more risk averse. There's nothing irrational about becoming more risk averse because this again is a reminder of the dark side of globalization, right? We need these reminders sometimes. Say, oh, you know what? I'm underestimating the risk of globalization, which is everybody's problem is now everybody else's problem. So these reminders have been coming once a year for the last 10 years. It's Greece, and then you have another crisis. Every year there's a market crisis of one kind or the other. It plays out in markets. It always leaves an imprint. I mean, you don't always, if you always bounce back from every crisis, you go back to where you used to be, then you say, who cares? But I think these crises collectively change perceptions of risk, especially something like this one, because you're seeing how exposed we are because we travel so much more because again of globalization. Everybody's everybody else. That all you need is something like this to remind you that if something starts to happen, whether it's a disease or an economic dilemma, it's going to start very quickly spreading around the world.
I have another question on the risk-free rate as a proxy of the long-term economic growth because you are using, you are trying to estimate the econ growth 5 years
For a
from now.
mature market.
Yeah.
No, but if you, yeah.
5 years from now,
Yeah.
in 5 years time. So why wouldn't you use a forward rate
You could,
implied by?
you could. It won't change anything, right?
Okay.
Because you'll have a higher, so if you think about the equation, it just makes the equation, both your R and your G will be higher. So let's say you believe that at the end of 5 years, the risk-free
Yeah,
rate is going to be 3%. The R will go to 3%. The G will go up because it's higher. So both numbers change. It's R minus G in the denominator, right? That effect. So that's why I don't even bother, because
Okay,
both
I
numbers
see,
could be
I see,
different, but the difference is what matters.
I see. Crystal clear. Thank you very
Okay.
much.
I wanted to ask you a question about the risk premiums
Yeah.
being shorter in long term versus short term, right? So ideally, when you are going from short term to long term, this is the yield curve.
Yeah.
And the stock price is going to be more than this. But
No,
at
no,
any
don't
point,
think of it
because
this
of
way.
liquid,
No, so basically, so this is,